Thank you so much for the introduction. Before I start off, I want to thank Karan for inviting me to present my little bit of knowledge on the show with everybody present. So thank you so much, Karan and Finbridge, for having me here. Most of what I will be presenting has already been touched upon by Bharatji. I will try to share my own perspective on this. I've been listening to the presenters before Bharatji, also especially Milind sir, and they've all set such high benchmarks. It's going to be interesting to try to match them. So I would like to share my screen quickly as we start, and maybe Karan, if you could just be kind enough to confirm that you're able to see my screen, that'd be great.
Yes, your screen is visible.
Okay, sweet. All right. So before I start, I just wanted to kind of introduce myself and my company, even though the introduction has been given. So my name is Kavita Agrawal, Mrs. Kavita Agrawal. I got recently married, and I'm a qualified CMT and CFA. I started this company during the pandemic when I was still working at Shell. With pandemic, because there was no requirement to travel to work anymore, I decided to take on what has been my passion since the past 8 years on a more sustainable basis, and so that's why I started my company. The company is called EXP-Invest. It basically stands for experience, expertise, and exponential, which is what I think really inspired me to do this, because I've been working in the stock market, or trading in the markets in the past 8 to 10 years now. So I have that much of experience. I've studied CMT, I've studied CFA, and I've been practicing relentlessly. So that's where my expertise comes from. And then using a combination of both of these, I really believe that I can make exponential gains for not just myself, but also people around me, my friends and family, and everybody really encouraged me to go out and start doing this. So with that introduction to the company, quick introduction to the company, I will move on to our topic, which is swing trading with RSI and moving averages. Now, in this session, I will break down for you what is swing trading, why do we swing trade, how do we swing trade, and then RSI, my way of using RSI, because most of us here are already professional traders and ज़्यादातर लोगों को already in indicators के बारे में पता होगा. These are pretty much, you can call them rookie indicators in the sense कि जब भी कोई market में नया enter करता है, they start off with these indicators, RSI and EMA. But despite of that fact, it is astounding how much potential these very simple to use indicators have. And I will also be showing you the whole setup, which enables me to maximize and utilize this this particular combination of indicators to make profits consistently. So we'll start off with swing trading, the what, why, and the how. We will delve into a bit of setup discussion. And then we will finally move on to RSI, EMA, and the combined views, and then we will move on to the conclusion. Now, so what is swing trading? Now, swing trading is basically, as we all know, it's a kind of market participation, which in very layman language, if you have to put it, it's just less intense than intraday trading and more engaging than long-term investing. The reason for me to put it in this way is because a lot of people who, even in after Bharatji's session, I could I heard a lot of questions about intraday trading. I want people to understand that intraday trading is not easy. You are only thinking about your capital, and that is why you want to intraday. You are only thinking about the fact that you can probably make 10,000 rupees if you take, say, 50,000 rupees to the market, and you can buy low and sell high and make quick money. But it doesn't work like that, because it's not just about your capital. You are also taking to the market your energy, your time, and your resources. There's an opportunity cost associated to your time, and of course, the stress level, the frequency of your trading, the associated costs to that trading. You have to consider everything. So that's why I say that intraday trading is a lot more intense. So swing trading basically comes between that extremely intense intraday trading and the way less intense long-term investing. Long-term investing may, usually people who are long-term investing will tell you that, you know, if you're feeling too excited, you're doing it wrong, because वो साल भर में maybe 4 maybe 5 trades execute करते होंगे, जबकि intraday trading में people, it's very easy for people to execute as many as 10-15 trades in a day. Swing trading comes in the middle of that. Now swing trading can you know have it has a long breadth. It जो trader है वो उसके ऊपर depend करता है वो कितना intensity चाहता है. Now for example, I like to trade with holding period of not less than 2 weeks, but it can go as high as 3 months. Usually, I do not prefer to hold my swing trades for more than 3 months at a time. Starting on the wrong foot in the stock market usually implies starting off as an intraday trader. In theory, not actually in theory, it just sounds easier, but trust me, intraday trading is very hard, to the point that every professional trader will always recommend you against it. So like I was saying, swing traders operate in a very broad range of trading frequency and holding period for their trades. Swing traders have a lot of control on how frequently they want to trade and for how long they want to hold on to their trades. Therefore, there's a lot of room for experimentation, continuous learning, and non-stop improvement implementation. I would like to delve into this part a little bit. Where does this experimentation, continuous learning, and non-stop improvement comes from? When I say continuous learning, I am not talking about you going out and attending lots of seminars, webinars, reading lots of books, taking lots of courses, talking to lots of experts. No. That's the learning part. The continuous learning part comes in when you decide to embark on the journey of swing trading. You start maintaining your own trades, your own records, your own reasoning for why you did what you did, and then every quarter go back and study all that. See, it's very easy to build a system. It is every single book will tell you 10,000 ways of making money in the market. But the only reason why people lose money in the market, which is more than 95% of the people who come to the market, is because they don't have control on their own emotions. They don't have control on their own execution. They don't have control on themselves. The only way to have control is meditation is one way, but the other way is to identify the triggers which make you take wrong decisions, implement wrong executions, and eliminate those patterns. You have to identify and then eliminate the patterns. Yeah, so that is what comprises of continuous learning. I actually did a video on trade journaling sometime back. It is still on my YouTube channel. You can look up for EXP-Invest.in on YouTube and you will find my channel. There's this video on trade journaling. It's an hour-long video where I've just spoken about why trade journaling is important and how much it helps you. So even Bharatji was talking about this, that, like you have to keep learning, you have to keep improving. That learning, improving will only come if you have access to data. The data will only come if you have discipline. If you have discipline, you have to maintain your trade journal. You have to know what you did, why you did it yield good results or bad results, and against that you have to determine what changes you need to make in your behavior in order to become more profitable. You have to identify patterns, behavior patterns in your execution which are leading to consistent losses, eliminate them, identify patterns which are leading to profits, multiply them, implement them more and more. That is what it means by continuous learning in the journey of swing trading in the stock market. Now, Coming back to some theory, swing trades usually last between a couple of days to several months. As long as it's less than a year, it's called a swing trade and not a long-term trade for tax definition purposes. Unlike intraday trading, that's unlike intraday trades, of course, in which trades last for just one day, and long-term investing in which trades can last for multiple years. Yeah. Okay, so why do we swing trade? The one and only reason for swing trading, or as I like to call the mother of swing trading, is trends. Because trends exist, we swing trade. Now, with swing trading, basically, we are aiming to capture price swings in the direction of the trend. When you want to swing trade, like in a lot of books, a lot of webinars, a lot of seminars, everywhere people say trend is your friend, but honestly, trend is not your friend. Trend is the mother of swing trading. If there was no trend, there would not be swing trading. That's my belief. The friends, however, that you have in the stock market are your support and resistance levels. If you identify them well, if you use them well, you'll be able to make a lot of money in the stock market. So we also know that price never moves in a straight line. Even if you have an uptrend, it does not mean that the price will continuously move in an uptrend. These are very basic things, but then they are very important to understand, because not just knowing, but having a clear understanding of the basics ensures that you are able to build on that basic stuff and make money consistently. A lot of times people have, I interact with many newcomers in the market. I interact with a lot of people who've been in the market for a very long time. And I have seen that a lot of people have very wrong notions of the market, of how it trends, how it moves, and how it should behave. So that is why I'm basically touching on the basics. So like I was saying, prices never move in a straight line, but it zigzags its way up to either the top or the bottom until a reversal happens. Now, between the starting point of a trend and the reversal happening, there is a window of opportunity which we want to take advantage of, and therefore we are swing trading. Now, we are not swing trading because we have very high conviction for long-term prospect of a certain economy or industry or sector, or even stock for that matter. Because if we would not be swing trading. We would simply be doing long-term investing, which again is something that I do. But here, let's just talk about swing trading. We are simply swing trading because we have unwavering belief that price action can be anticipated due to the tendency of price to trend. And as traders, it is our job to identify the trend, get in as early as possible, and stay with it until there is sufficient proof of reversal, and then get out. Yeah. After all the effort, if we have managed to capture even 1/3 of the trend, forget about catching the top and the bottom entirely, we are successful. And 1/3 of any trend is what we should aim at capturing consistently, owing to the crux of any swing trading system. So what you have to do is you have to identify the trend, you have to enter the trend, and then you have to book profits when the trend is about to get over. Now, here's what I mean by this. Once we have established the understanding of what a trend is, like as you can see on your screen, and also what is a swing, there are 3 steps of making money off it. And the swing 3 steps, that is, identify, enter, and book profit. Swing trading on a very high level looks like this. When we see price moving up after, say, a prolonged move down or sideways, we need evidence to believe that it's a trend. We can conclude a trend has been established only when there is a breakout above a resistance zone, as you can see here. And by the principle of fungibility, once the price has moved above this resistance, it becomes the support zone and the potential entry point for us. So this becomes our entry point for this particular trend. And once we have entered, we now ride the position for as long as the cluster of evidences prove it's time to get out, or our trailing stop loss gets triggered. So this was a very high level understanding of what we should do. As you can see on this on this graph, I've also indicated the holding period in terms of days and the price movement in terms of percentages. So you can get a rough idea of what I am exactly talking about. Yeah. Now let's move on to the setup. Mostly I'm talking about my own personal setup, which I prefer to use in the stock market, which I've been using since, which I have, developed after listening to a lot of market experts and my own experiences and my own personality, my own comfort level. And this is, what it has, like last 8 years of work, this is exactly what it has boiled down to, and this is what I would like to share with you. So in order to identify stocks and opportunities, I use a top-down approach. Yeah. I basically look for broad market themes which are yet to unfold. Now, these themes are initially well hidden in, business news portals like Economic Times or Money Control, but they're very well hidden, or even the newspaper for that matter. They're always there. But they're really hidden in articles. They're in like corner articles, and they're initially not in the headlines when these themes begin to unfold. They are not part of any featured articles. For example, the news of the demand supply issue propping up in the steel sector, it did not start hitting headlines or featured articles until it was quite late. Although steel stocks had rallied, but then if you go back and look at the archives, the news had already started building much earlier, but it was just that you had to dig a lot deeper to be able to access the same. Then again, another example would be the rally which we witnessed in the real estate sector, because the government was pushing for it. The policy changes that started coming in were initially part of really small articles, but then after the rally in realty sector happened and stocks propped up quite a bit, full-scale articles started coming on that, and then that is when retail investors started getting sucked in. All right. Another very good example, and my favorite example, is what happened in the sugarcane, in sugar stocks. I remember reading an article, a very small article many years back, about how government was going to allow the use of sugarcane to produce ethanol directly rather than the use of molasses. And I looked that up and I realized that, the same had happened in Brazil before, and that really pushed the sugar industry in Brazil to, a different trajectory of growth. And I thought, well, this is great. And then I looked at the chart of Balram Puccini, and I saw an opportunity. I saw strong positive divergences. Balram Puccini was at 71 rupees that time. Now it's like, it's way up. We all know that. But that's what I mean by, using the top-down approach and trying to identify themes early on, which will impact the whole industry sector, not just specific stocks, but you want a whole sector or industry which will be impacted by these themes, which impact demand and supply, or government push, incentives for the government, or change in the market. These are the kind of cases that I am always on the lookout for. I'm basically always reading news to try and identify something of this sort. It's really like, it's very close to looking for a needle in hay with all the noise and so many unnecessary articles being posted all the time. It's getting harder and harder, but it's price for participation, I guess. So after I've identified such sectors, I then tend to look at stocks which are usually leaders in these particular sectors, and then go with them. Now, these changes are often related, like I said, they're theme related. So you have to be very careful of identifying the theme and then opting for the best players. Now, the next thing in determining your swing trading setup is determining your entry and exit. Now, to determine, swing trading is all about being on top of your numbers. It is not so much about what indicators you're using or what charting software you're using. It is literally all about knowing your numbers, because money is nothing but a game of numbers. As long as you're in positive, you're doing good. Once you go below zero, you know. Okay. So nothing is too far from reality when it comes to the downside, and trust me on that. I'm talking about the risk of ruin because, you know, the trading world is very slippery, and ruin happens more often in the trading world than in any other space. And any person who trades in the market, and I'm only talking about people without leverage. I mean, people with leverage are way out of the context, like way out of this discussion. But even without leverage, the risk of ruin is very real if you don't uh, have a proper entry and exit system. Yeah, just even if you're an analyst, see, I really believe that in order to be a successful swing trader or any kind of trader, you need two things. One is you need to be able to analyze stocks and pick stocks correctly. And secondly, make the right entry and exit. Even if two people have the name of the same stock at the same price, may not necessarily make money. Both of them may not make money. That is purely because of difference in their execution. One person might, you know, be a great analyst and might be able to pick the stocks and, you know, tell all their friends that, okay, this is a stock, it's showing a great opportunity, I think you guys should buy it, and, you know, buy the stock himself or herself. But then after a short profit, or, you know, nervousness or greed or whatever reason, may just end up selling the stock too soon, or have a stop loss that's too tight. Whereas another friend might, you know, based on your analysis, based on the analysis of the said person who is an analyst himself or herself, may go out and buy and actually hold on to the stock and make more money. So that is why execution and stock analysis, or any kind of analysis, are two completely different ball games, and you need expertise in both of them to make a sustainable, consistent profit in the market. Yeah. Just correct analysis, like I was saying, is not enough. Trusting yourself to stick to the analysis, which either you've made yourself or you've received from somebody, is more important. There are so many personal biases and external influences, so many doubts, so many emotions, which are constantly attacking your senses, that just being conscious of them really changes the game for most people who are attempting to be successful at swing trading. Yeah. Now, trade selection is, of course, very important. I personally prefer only those trades which give me a minimum of 3 points for every 1 point of risk. I'm talking about risk-reward ratio. I think Bharatji already detailed a lot about it, so I'm not going to go into great details because I don't think I can top him. But, you know, risk-reward ratio is basically what reward you, or rather what risk you're willing to take for the reward which a particular analysis is offering you. For me, that criteria is 3-1. I will never risk a point unless 3 points are being rewarded to me for that risk. And it has to be based on analysis, not hearsay, and not hope, definitely not hope. That's important for me. Having a risk-reward ratio criteria really improves the odds of making money. There are lots of studies which show that, you know, even if like on the basis of coin flip, if you started investing, you'd probably make money. But the only way to actually improve those odds are if you have a consistent and rigorous, strict risk-reward ratio in your trading system. Because you have to understand, you need to stay at least at break even, if not making money, in all market types. Swing trading works best only in upward trending market, but the market is not always upward trending, right? The market goes sideways, the market goes downways. And if you're not being picky about what trades to take, how much reward each unit of your risk is deserving of, you will not be in a favorable position. And what I have realized, and it's mathematically proven, that using a risk-reward ratio enables me to stay at least at break even if only 25% of my trades are profitable, that is, they're hitting target. Imagine 75% of trades that I'm taking, even if they're hitting stop loss, I'm at least managing to stay at break even. I'm not losing money, which is amazing. I mean, this is right there beating the odds. Now, if I am able to at least meet the odds of 50-50, you can imagine, the profits go up pretty aggressively. All I have to do is stay very strict about what trades I take and not be tempted into taking anything just for the sake of trading or staying active or staying engaged. It's really like hunting. You have to stay relentless. You have to look for the right setup, because you have to realize the importance of your capital, of your money. You cannot afford to lose it. The situation in swing trading can further be improved if you're using trailing stop losses. So in order to use, how I particularly use trailing stop losses is that once I've entered a trade and once it starts moving in the direction of my target, I move my stop loss up to cost once it has moved enough to cover from my stop loss level. So for example, say my target is 4, yeah, and my stop loss is 1. So once the price has moved up 1 rupees, I will move my stop loss up to my cost, so that even if my analysis was, say, wrong in the first place and the price reverses and starts falling down, at least I'm getting stopped out at my entry level and not incurring a loss in this situation. There is this very famous saying which says, make hay while the sun shines. It's so popular, but if you think about it, sun barely shines for 1/3 of the day, even on a sunny day. And then there are so many days which are not sunny. Rest of the time, you just got to protect what you have. And in this case, it's your capital, right? Again, very important for swing trading is to have your stop loss and your target pre-decided before you enter the trade. Because once you have skin in the game, once you've put your money, your emotions are going to play havoc. It's not, objectivity is lost. Personally, for me, that's very relevant because I'm a very emotional person. And when I entered the stock market, when I decided to take swing trading as a full-time profession, it was a real, look in the mirror for me, because I knew I had to separate my emotions from my objectivity, and I had to implement a system which would enable me, to stick to my analysis better. So having stop loss and target decided before entering the trade is the way to go for successful and consistent, proper, disciplined swing trading. I cannot emphasize that enough. Now, coming to the next part, which is talking about the screen setup. Okay, so for my screen, for my chart, I like to have a layout with 6 separate charts. As you can see, there is a color scheme which I have applied to this. So I have the monthly, weekly, daily, 75-minute, 15-minute, and the 5-minute chart. Yeah. Now, the reason why the 5-minute and the monthly is grayed out is because I barely ever look at them, but they're still there. For me to get the bigger picture, like once in a blue moon, and the very granularity, if there's a lot of volatility in the market, that's the only reason that they are there. The main decision for swing trading for me comes from my daily chart and the 75-minute chart. Now, if you're wondering why 75-minute chart, because you don't usually get to hear, I have very simple reasoning for it. When I was using hourly charts, I would see this very small, I use candlestick charts. So in candlestick charts, when you see these very small candles, which were, made up of the remaining 15 minutes of the day, because the day is made up of 6 hours and 15 minutes, that 15-minute chart would result in a very small candle. Now, in candlestick analysis, that small candle basically means indecision. And this was kind of misleading. So in order to solve that, I took 375 minutes of the day, divided it by 5, and started using 5 equal candles instead of 5 equal candles and then 1 broken candle, because it's just, I think, more uniform. And I think it's very important for candlestick traders to have 75 minutes chart instead of the 1-hour chart. So my primary decision making for swing trading comes from the 75-minute and the daily chart. However, I use the weekly chart and the 15 minutes chart as well. The reason being, if so there's a concept of eclipsing. All of these 4 time frames for me, especially the weekly, daily, and the 75-minute, have to be aligned in the sense that they have to be saying the same story of potential upside. If there's a scenario where the weekly chart is showing, say, a negative RSI divergence, but the 75-minute chart is screaming buy, I would rather avoid that trade, even if the risk reward ratio is like 5, because my weekly chart is like, you can say it's like the senior of the family. If that person is opposing you, it's not going to work. Ultimately, you're going to get crushed, you're going to get stopped out, or something of that sort will happen. So I always want an eclipsing between these time frames. 15 minutes chart, I also would like 15 minutes chart to echo the same story which 75-minute and the daily chart are echoing, but it's not a decision changer for me. It's more like building up confidence on my entry setup. So that's the reason why I use 75 minutes chart. And as you can see, 75-minute and the daily chart is what I primarily use to identify trades for entering and exiting my swings. On indicator side, I use the cliche and the most common 100, 200, and 50 EMA moving averages. I will talk to you more about moving averages in a bit. What I want to talk to you about now is the RSI. Now, for RSI, instead of using the usual 14 period, I personally prefer to use the 25 period on my 15-minute, 75-minute, and daily chart. For the weekly chart, I prefer to use the 8 period on weekly chart. Now, why do I do that? I'm going to tell you in a bit. But before that, this is how my trading screen, this is what my trading screen looks like. This is a Nifty 500 chart for your reference. As you can see, there are 3 moving averages. The blue line is basically the 200 moving average, 200-day exponential moving average. The green line is the 100-day, and the yellow line is the 50-day moving average. I have the monthly, weekly, daily, 75 minutes, 15 minutes, and 5 minutes chart. Now, the reason why 75 minutes chart is on the right side of the screen and not the left side of the screen is because I place my monitor, which has my screen display, on the left-hand side, and I want the daily chart, that is the daily and the 75-minute chart, closest to me, and I'm okay with having the monthly and the 5-minute chart away from me because I already, like I said, I use them very sparingly, so it's okay if they're away from me, but I need the 75 minutes chart closer to me. This was a very recent change, and I think it's been really a game changer for my neck. I don't have to crane as much anymore. So, in trading, you also have to take care of these little things which, make it more comfortable and more easy for you. Okay, now coming to my RSI setup. Now, RSI, as you all obviously know, is a relative strength index indicator. It's a leading indicator and a momentum indicator. It uses the price's own momentum and own strength against which it has displayed in the past certain periods against itself to determine how it is doing as on today. There are lots of nitty-gritties of reading RSI. It's like a whole book, a whole volume can be written on trading with RSI because there's just so much to it. It's like a whole personality in itself, I believe, this indicator. Now, why do I use the 25 period and not the usual 14 period? The reason for that is, very simple. When I moved into professional practice, before I moved, I was also using the 14 period setup, and it was working out great for me. But when I started practicing, trading professionally, I began questioning everything, not in an attempt to reinvent what was already established, but in order to understand the cause and effect of everything better. So for my purpose of swing trading, I wanted an indicator that was something less volatile than the 14-period RSI, and but I still wanted it to be banded like the RSI. I did not find any solid rationale for externally for using the 14-period. I do remember reading somewhere that after much experimentation, this was the period that appeared to work the best for the inventor. So that got me, after a very brief period of experimenting with new indicators, I simply reverted back to RSI because I was already comfortable with it and I'd already seen good results with it. It didn't make sense to go out and do the whole process, years, which honestly takes years of work all over again. I simply began experimenting and tweaking the length of RSI until I found the one. After weeks of experimenting and backtesting, I realized that the 25-period RSI actually works wonderfully well when it comes to the Indian equity market. Now, this is not true for all asset types. This is a disclaimer. I have used it only against the Indian equity market. I have tried using it against other asset types, but it does not work just as well as it does for the Indian equity market. Again, I'm not saying that it's better than the 14-period RSI overall. That may be working for somebody else, or may not be working for somebody else. But for me personally, my perception is that the 25-period RSI works because, again, the stock market is highly subjective, and different people, depending on their personalities, perceive it differently, interact with it differently. And I think as long as it's helping you put bread on the table, whatever works should be perfectly fine. So personally, for me, that's true with the 25-period RSI. So please, before you make any massive changes to your personal analysis screens, do not forget to backtest relentlessly. Okay. So coming back, again, 25-period RSI is also very important for me because, and this is important, it weaves different time frames into consideration. Now, what do I mean by that? Usually when we move down from one time frame to another, say from daily to 75 minutes or 75 minutes to 15 minutes, we are just breaking the price and plotting it into smaller sections for granularity of price action. I personally like to have a reflection of the larger time frame in my analysis of smaller time frame. So weaving different time frames into one another helps me get a better understanding of the relative strength of price momentum on a less volatile basis, which I think is the need of the hour in times when we are recovering from a pandemic, brewing a war, facing never seen before global supply chain issues, super swollen retail participation, which is like the perfect tadka to this whole mix. And to mathematically explain to you what I mean, say for the 15 minutes chart, where I'm using the 25-period RSI, if you multiply 15 and 25, that is basically 375 minutes, which is equal to the number of minutes in a day. So for every new plot of RSI, every new plot of RSI on the 15-minute chart, I am in a way considering the length, the price action of the whole day through RSI. Same thing applies to the 75 minutes chart. When I use the 25-period RSI on the 75 minutes chart, it is basically taking into consideration the past 25 RSI points, price data points, which culminates to 1,875 minutes, which is basically a whole week worth of data, 5 days, a whole week worth of trading data. And again, when I look at the 25-minute RSI on the daily, I'm basically looking at, by the same extension, I'm basically looking at the monthly data, which is 25 days. So that is how it helps. So when I'm basically looking at the 75 minutes chart, I am looking at price action worth one whole week through RSI. It helps me reduce volatility by a great deal, and it helps me build more confidence in the signals which RSI is giving. And that is, of course, very important because RSI is the primary basis for me to pick my trades. Yeah. Okay, moving on to moving averages. Now, in moving averages, there are several types. I personally prefer to use the exponential moving average. The reason for me to use exponential moving average is because moving average as it is a lagging indicator. However, the exponential moving average has a certain sense of urgency compared to the simple moving average. It tends to latch on to price better than the simple moving average. It also takes into consideration uh, the last data point of the EMA itself, which helps us avoid a drop-off effect. So like if there's been a big move in the price in history, with simple moving average, you will see that the average will suddenly drop off and it will be an extreme move, but not with EMA. There will still be a drop off, but it'll be softer. It also gives, at the same time, exponential moving averages tend to also give more weightage to recent prices than the simple moving average, which is extremely great. However, that being said, we all know moving average is not a very good indicator to initiate trades on the basis of, but it's a good adding confirmation element. It's good for adding confirmation element. It's good for following up or accumulating evidences once you've done the groundwork. Now, in my system of using RSI and EMA together, I basically make entry based on trend, support, and resistance. Like I said, support and resistance are your friends in the market. So my entries are based firstly on trend and then further refined based on the available support and resistance levels. That's how I identify my stop loss and my target levels. But more importantly than that, I look out for divergence between RSI and the price action. RSI divergences don't work 100% of the time, like literally everything else in the world, but I think they have a pretty good dependability, or so I have seen in my own trading. However, when using RSI, a lot of people just think using the 30 and the 60 level, the overbought and the oversold level is enough, but that is not enough. You have to consider the direction of RSI. You have to, direction in the sense that if you want to go long, you want RSI to be moving upward after touching, after taking support at 30 and not to be falling towards 30. So you might consider RSI being at 35 a good indication to go long, but then if it is falling from 60 and downward, and if you're entering a trade at that point of time, that may not be in your best interest compared to when the RSI is moving upward from after having taken support at the level of 30, and and so that again boils down to the same point that I've repeated several times, is that go with the trend. So that is one thing. The direction of RSI is extremely important. Another very important aspect that you have to take into consideration when you're using RSI is the range shift. Range shift, so RSI during different market types has different ranges. So in the bull market, RSI can have, so in the bull market, RSI usually has a range of 30 to 70, or 70 plus, actually, not exactly 70, but 70 plus. In a bull trend, RSI tends to breach the level of 70 more times and take absolute support at the level of 30. This applies to both 14 as well as the 25 period RSI, which I use. But what I see is that in my 25 period RSI usage, the touch on 30 is a lot less. So that for me gives, that for me is indicating more refined buy signals and not, giving me false signals or taking fake jump offs 30 and then going back, breaching, and then triggering stop loss. The whole circus can be avoided just by reducing volatility on the chart. So that's one. Again, if you are also a short side trader, then it will be important for you to know that range shift also happens in the bear market, where you will see prices, RSI taking strict resistance at the level of 60. But on the downside, when it starts falling, it tends to go 30 minus. So range shift for the bull market, you have to look out, you have to identify that your range should be 30 to 70 plus. And for bearish market, your range should be around 60 to 30 minus. That's how you work with it. Now, of course, so that was more about entering the trade. Now, in order to enter the trade, like I said, I use RSI, divergences, and range shift, but also key support and resistance levels, which are visible on the chart. Because you can also, how do you use these key support and resistance levels? I'm sure you all know about bracket orders, or popularly called as GTT, good till triggered orders, which are available on Zerodha, and I absolutely love that feature of Zerodha, the GTT orders. So for key support and resistance, now suppose I have a stock which I really want to make a great entry at. I'm going to show you an example, Alok Industry. I want to make an entry in that stock. So what I basically would do, I would draw my trend lines, I would look at my RSI. So at this point of time, in order to use bracket order for making your entries, RSI will not be immediately useful. It will be more useful in confirming the trade if at all it is executed. So I use trend lines a lot, and also Fibonacci and channels. I'm a big fan of those tools for trading. So especially for upward trading channels, if the market is in a short-term bad trend or downtrend, but I have a belief that a stock is only taking a temporary downside slide, a temporary slide to the downside. What I would like to do is I would like to identify my support level on the trend line and then use the GTT order to place a buy trigger, so that if the price spikes lower, which has been happening a lot, right? So you have to take advantage of that. So if the price spikes lower, I want to be able to buy that stock at that lower price. And so I use GTT orders for that. Again, EMA, like I said, it's not, moving averages are not great for making decisions, but if the stock is on the daily chart and on the 200 EMA, I will definitely make it a point to analyze that stock and keep analyzing it till I see opportunities that I can probably go long on. Because if you do a historical analysis, you will see that 200-day moving average is quite often a very good support level for stocks, and many times, even in the corrections like the one that we are witnessing right now, it often tends to make a pretty good level to enter stocks, especially stocks which are have been extremely bullish and have been registering regular new highs. Usually the 200-day and the 100-day moving average levels prove to be very good entry points. So that's about the entry. Now, for exit, if I have to talk more about the exit, again, for exit, like I said, you have to have your stop loss and your target pre-decided before you put your skin in the game, before you put your commit money to your trade. You have to use bracket order. I am absolutely committed to setting my stop loss and my targets. I interact with a lot of people, and they have this complaint that, when we set up stop losses, our stop losses get triggered, and after triggering the stop loss, the stock just tends to reverse and go back up. So we don't like to use stop loss. That kind of mindset can be very dangerous in the long term. It might work in your favor for 1 trade, 2 trade, 10 trades, but the 11th trade will just wipe everything out. That's how it happens. If you are suffering from the problem where your stop loss is getting triggered, but your stock is turning around, don't blame the stop loss. Don't blame the practice of using the stop loss. Go back to your trade and think about why you use the certain stop loss. What could you have done differently? Was the stop loss actually mentioned to you as a stop loss or as a support level? Because a lot of time when the price starts falling down, it'll briefly breach the support level and then turn back up. So it makes sense to always have a stop loss which is a few points below that support level. And that is what I prefer to do. I've also been through the pain of, stop loss getting triggered and then my stock moving up to even reach my targets, and I'm missing out on the entire thing. But because of relentless trade journaling and analyzing my trades in the past, I came to the realization that it's better to tweak my stop losses slightly and maybe make it even bigger, as long as they're still meeting my criteria of minimum risk to reward ratio of 3. I would rather still use it than not use it, because a lot of time, if you're not using stop loss, or if you're thinking to yourself that, okay, if this price comes, I will definitely exit it, but say the price moves too fast, it's gone like 2-3% below your stop loss level. Now you don't want to execute your stop loss, like you don't want to exit because you don't want to take that much amount of loss, and then you're hoping that if the price bounces up, I'm going to exit. But do we really exit if the price goes up? No, because we become hopeful that, okay, it's gone up 2-3%, it's gone back up 4-5%, maybe it will go up further. But that never happens. It just keeps falling, and then it keeps falling, and suddenly it's not a swing trade anymore. Suddenly it's become a long-term trade, right? Everybody who's in the market has been in that spot, and the only way to, and that can be really painful, because you would have maybe lost opportunity to make money on 5 stocks, but the actual money that you might have made on other 5 stocks is going to get wiped out because you did not use stop loss in just one stock, and that is very painful, my friend. Do not do yourself a favor and take yourself out of that situation that you're constantly finding yourself in, and start using bracket orders. For GTT, it's a life changer. In fact, I also want to discuss with you all, or show you all the template which I'm using, which I also share with members of EXP for free. It's also available on my website, by the way, under members resources, which helps me keep a track of my GTT orders and whether I have applied bracket orders to my trades, because there are so many stocks, there's so many trades. It can be very hard to keep a track of all this, and having an efficient system is very important. And I wouldn't say I have an efficient system, but I would definitely say that I am moving towards it, and it seems to be doing wonders for me at this point of time. Even when the market is bleeding terribly. So another reason, so despite of I'm not 100% reliant, in the stock market, nothing is 100%. You cannot rely on anything completely. So despite of having GTT orders, I obviously keep a close watch on my stocks. And if I notice a negative divergence on, say, the 15-minute chart, now this is where the 15-minute chart is mostly useful. I use it to mostly track my active trades. If I see a RSI negative divergence, say on the 15-minute chart or the 25-minute chart, I'd be careful, and I would not exit my trade immediately. I would definitely move my stop loss closer to the price. Then another reason, another thing that I would look out for, which is usually already taken into consideration in my target setting, is key trend line resistances. Trend lines, if you know how to draw them correctly, work so beautifully on stocks and even other assets. It's like magic. I don't know how it does it, but it just works, and I believe in it. And another reason, another way of exiting for me is, of course, trailing stop loss, which I've already touched upon briefly before. So I'm going to let it be at that. So as I was telling you earlier, this is the chart of Alok industry, and I wanted to show you that I had this, if you can see this yellow line on this chart, I had this trend line drawn from a long time. Now you are looking at the 75-minute chart of Alok Industry, and I had GTT orders placed between these two trend lines. If you see, there is another trend line, blue trend line. So I use different colors of trend lines for lines that I'm drawing on different charts, because I want to be able to see these these drawings across my time frames, but I also want to know which time frames, prices, and levels I use. I mean, they are the same, but the data doesn't always fit when you go into more granularity. So knowing that it's a yellow or a blue helps tell me, it tells me whether it was drawn on a weekly chart or a daily chart or a 75 or a 15-minute chart and so on. So that's why it's different colors for different time frames. So I could see that, the price of Alok Industries was falling, and I've been swing trading Alok Industries for many months, and it's been doing, it's great. So I wanted to basically buy in this whole range. So instead of putting just one single order, I had multiple GTT orders set out between this these two particular trend lines. And when the price, on this day, I don't know which day it was, but whichever day it was, when the price gapped down, my GTT orders started to trigger, and my stock got bought. The last purchase happened here. As you can see, there are also 3 dots. This is another thing that I like to do. I like to mark my trades on the chart. The reason I do it is because I have a fixed universe or a semi-fixed universe of stocks. I've learned the hard way that you cannot chase every stock. You have to have some sense of loyalty if you want to be a good swing trader, because every stock has a very different kind of walk. Like, different people walk differently, different stocks move differently. Just like you have to be friends with a person to understand their personality, to know about their behavior, to understand them, and to be benefited in their company, same way you have to befriend a stock. You cannot keep going after new stock every day. It will not give you a sense of familiarity, and you have to be familiar with stocks. So so that is the reason I like to put these green dots for when I make new positions in a stock, and then I like also to put red dots for when I exit the stock, because like I said, I have a watch list of around 130 to 150 stocks, which I am also trying to reduce. I feel even that's too much. Earlier I used to trade the Nifty 500 constituents. That started becoming too much, and I realized that if I want to have a more efficient system, I have to reduce the universe of the stocks. Also, I have a very bad memory, so I cannot remember stock prices a lot of time. So I decided that I wanted more familiarity with the stocks that I was trading. And the market has been so volatile. There is so much movement in stocks. I really, I realized because of my trade journaling, because of my constant studying of my own data, it was such a treasure house, and it showed me, I drew the insight that it would serve me better to have a smaller universe of stocks rather than trying to chase every opportunity which seems perceivable. Because again, different stocks, respond differently to even RSI positive divergence. We all know that if there is a positive divergence between RSI and price, you can expect the price to go up, but not all stocks do that instantaneously. Some stocks have a tendency to move sideways for a long time and then start moving up. Some stocks have a tendency to go down again, make another low, and then start moving up. Some stocks have a tendency of moving up very quickly. Some stocks have a tendency of, something else. So you have to know the general tendency of a stock. And I think that is what I have started identifying. And getting more ahead of since I reduced my my watch list. I'm working on still eliminating more stocks. I want to bring it down to maybe 60 to 80. So it's a long road. But coming back to this particular screen, marking your trades, it's not, it sounds and seems like a lot of work, you know, using different colors for trend lines, using putting dots for the trades you're executing. But then it's part of the system. And like I said at the beginning of this webinar, swing trading, succeeding in swing trading is not so much about the indicators that you're using, but more about the discipline and the system that you're actually implementing. So this is part of my system, applying these green and red dots on my chart, so that when I say look back at this chart, I know at what level I executed what and what was the outcome. It's a 1 second shot snapshot. I don't have to go back to my Excel sheets and Google Sheets, and I don't need to filter them, and I don't need to identify the particular trade that I took at that particular time or, you know, recently. And I don't have to come back to the chart to identify those levels and then see, you know, what happened where. I don't need to do all of that work, because, you know, the information is right in front of me. It tells me the date, it tells me the level, and it tells me what I did. You know, if you think of it, it actually saves me a lot of time, and I want to be able to access that data, which by I mean you also want to access that data, because, you know, you have to have visibility on your actions. So this was the alok industry. Like I was saying, I made the entry using GTT here, and once my position was made, I used another bracket order to set up my stop losses and my target. So my target in this trade was, it was kind of high. I think if I remember correctly, it was around 30 rupees. But, you know, the stock did not touch that level entirely. It kind of topped out. So I failed to actually book my profits around this level, but the stock fell quite a bit. I also had a trailing stop loss, but as you can see, there was a huge gap down and my trailing stop loss got skipped, which then again, you know, my biases kicked in and I did not exit my stock here. But the next time when it spiked, I moved up my stop loss quite a bit. I moved my stop loss up basically to the level which was initially skipped, and then it also got triggered. But the main point is that, you know, even though my target did not come and I could not capture the actual price high of you know, 29.75, but still my profits were at least preserved, considering that I was using a stop loss. Now you might think that, you know, why didn't you use, like, why didn't you exit it? Now, because this was a big move and my trailing stop loss had been avoided, I went on a spree to look for the next best support level. And knowing the nature of this particular stock, knowing that it can be very volatile, I did not want to keep a stop loss which was very close to it. That was the first trend line. I opted to keep my stop loss at the second trend line, the yellow trend line, which luckily was not triggered before the stock made another jump of like 16-17 odd percentage. And I was able to book that profit. I was able to preserve my profit because of some discipline. Like I said earlier, I'm a very emotional person, and getting into trade, getting into this profession of trading for me meant taking a very hard look in the mirror. And after a few terrible episodes of losing more money than my monthly paycheck, I realized I had to take my emotions and subjectivity out of my trading and replace it with something that would adhere to my analysis, but not allow for me to make on-spot decisions. So I monitor my trades very closely, especially when there is volatility, but I always use GTT, that is the Good Till Trigger Order by Zerodha, to mark my exits. So with that, we've reached to the conclusion of my presentation pretty much. The key to success, according to me, like I've already said, is not lie in the indicators that you're using. You may be using Bollinger Bands, you may be using Super Trend, you may be using other indicators, and they may work for you. Even if your analysis may be right, you may still not be succeeding because you may not have a proper system to implement your analysis. Like I said earlier, analysis and execution, two completely different ball games. You may be very good at analysis, but if you don't work on your execution, you will not be able to make money consistently. Consistency is the key. So you have to build a system surrounding, things like, don't forget to include risk reward ratio. Remember to stay loyal to it. Determine your entry and your exit strategy beforehand. Uh, uh, have a consistent screen setup. Don't keep tweaking your screen a lot of times. Like, don't keep changing it every time you make a loss, because you will not be able to learn on, you will not be able to learn if you keep changing it a lot. Be careful with your capital allocation. A lot of times I see people making the mistake of over allocating to trades, and that's not advisable. Always do trade journaling, and because that is what will actually help you in learning continuously and tweaking your implementation patterns. Now, as promised, I want to show you my tracking sheet. So this is my tracking sheet. As you can see, so over time, I have added lots and lots of columns to this, and I keep making changes to this to try and make my system more efficient. Initially, I used to have different sheets and different workbooks for different things, but then I realized it was not practical to continuously switch between different places. So here I have everything. You can obviously see a lot of colors on the screen. Don't get intimidated. Don't get scared. I'll try to tell you about the screen. So these blue rows that you can see, these are my active GTT orders, which are currently on, and these are, the buy and sell. So whether it's a buy GTT, whether it's a sell GTT is what is told here. I like to track my stop losses. I like to maintain my stop losses on the screen itself. And I like to also have my targets set up in advance, my percentage. Now this yellow column is the LTP, it is the live price. When I close a trade, I put the date, I mark the price, so this is the sales price, and then I hard paste the entire row. These percentage movements are pegged to the live price. So if, suppose the price comes close to my target level, then the target percentage basically goes to 0 and my stop loss goes up. So my stop loss also shows me that it's gone far away, it's time to kind of move your trailing stop loss. So then if this goes above, say, a certain threshold of, say, 8% or 9%, I will then quickly go and change my stop loss. There are color codings for everything. I also like to track the number of days for my, I've been holding stocks, because like I said, for swing trading, I prefer not to hold stocks for more than 90 days. Then again, I also track the market cap and the sector of the stocks that I'm trading and how much allocation I have. So this sheet actually comprises of 3-4 different accounts, which I have one for swing trading, I have one for long-term investing. So there are multiple accounts which are pegged to this single sheet. A few of the columns which kind of have personal data have been hidden for discretion. And like I said, these blue rows are for GTT. I also like to, so LT and ST basically tell me whether it's a long-term investment or a short-term investment, because having that visibility is very important. This is basically the date on which I'm initiating. This is the difference of the date from initiation to the day. So the number of days since the trade has been active. Then this is, what quantity I bought, what price I've bought, how much money I have invested. The sold date, the LTP, the current value of the price, so on and so forth. So there are lots of color codings for this. Like if a stop loss is triggered, the stop loss column turns red, the target column turns green if a target is approached. And Over here, it also shows me the number. So suppose if the day has been bad and the price has gone down and it has triggered a few stop losses, it'll pop a number for me here on telling me in one instance how many rows have triggered stop losses. So for example, say if this stock Abbott India triggers the stop loss, then it would show me 5 because I have 5 trades and all 5 of them have triggered the stop losses, which again, I can get to in a glance. I just have to hit my filter. Same goes for my target levels. So I've been working with the sheet for nearly 2 years now, and it has been very helpful in helping me keep track of what I'm doing. So that was about swing trading with RSI and moving averages. As you can tell already, most of it was around the whole setup that actually helps me implement the RSI and the moving average strategy, because these strategies by themselves are like super simple and super useful. So I think that's it from my side. If you're interested in getting a copy of the trading the investment, excuse me, if you're interested in getting a copy of the investment template, you can let me know. I'm happy to share it with anybody. My phone number and my email ID is on display on the screen for you. You feel free to reach out to me. I'm very approachable and I'm more than happy to help anybody interested in the stock market or even have a discussion about it. Also, please do take some time out to visit my website. I designed it all by myself, so I'm kind of very proud of it, and I would love it if you go and check it out. So that's it from my side. Thank you so much for being a great audience. I'll be happy to take questions now. Karan, you're on mute.
Yeah. Thank you for the nice presentation. Audience, if you have any questions, I wanted to ask one thing.
Yes,
you showed us you have shown us the 25 period moving average in relation to 14 period moving average. So can you show us some examples, like any stocks? What happens when we put 14 period moving average and compare with 25 period 25 period RSI?
Sure. Let me do that. That's actually a great point. So I have the Alok industry chart open here. Let me actually show it to you on this itself. Let me change both these charts to 75 minutes. So on the left hand side, we'll keep the length of RSI to 25, and then we will change the length of RSI on the chart on our left to 14 period. And as you can see here, on the 14 period, you can see volatility. I don't know if it's visible to you, but over here you can see that RSI on the 14 period RSI, despite of the price movement on both 75 minutes chart of Alok industry being exactly the same, when the prices gapped down sharply and went lower, RSI breached 30. And for me personally, breaching the level of 30 is a very big warning bell. Yeah, I would rather stay away from a stock and not touch it even for a swing play if on the 75 minute chart it is breaching 30. So that is what happened on the 14 period chart. Yeah, so let me just mark this here. RSI 14 period. And then let me mark this here as RSI 25 period. And on the 25 period chart, on the other hand, you can see that even though the price gapped down and moved quite a bit low, RSI gave, you can call this a positive divergence, and it stayed very loyally above the level of 30. So this was, this was a very good indication for me personally that, okay, despite of the fact that Alok industry has moved down sharply, gapped down even to the extent that it skipped my stop loss, and the price continues to move down. I was also very worried when it breached this trend line here. But when I looked at the RSI, I'm like, okay, I don't see RSI moving as low as, this, as the price. I don't see RSI breaching the level of 30. So maybe it's trying to tell me something. Maybe there is some strength. And then soon enough, Alok Industries started to, climb up again. And then there was this day with big 16% move in the stock. So here, as you can see, like the 14 period RSI is a lot more volatile and a lot more susceptible to a lot more susceptible to volatility than the 25 minutes chart. Now, if I have to, randomly, let's just, look at another chart. Let's see if I can show you anything on the chart of our favorite stock, which is Reliance. Okay. I was also talking to you about range shift. Yeah. So if I show you the chart of Reliance on, again, the 75-minute period chart from 7th of March, you can see examples here that when when Reliance started moving close to 2,187, the RSI chart, the RSI indicator on with the 14 period formation was breaching the level of 30. So this for me is an indication that weakness is going to continue. But if you look at the 25 period chart, because this is taking into consideration the whole weekly setup, we know that RSI is formed on the basis of prices. This is taking into consideration the price of the last 5 days, which makes up a week. And this is showing us that, okay, don't worry, there's not that much weakness based on historical prices. And because I'm taking a support at the level of 30, it might be a good time for you to maybe not sell the stock or hold on to the stock, or even enter the stock for that matter. Yeah. So that being said, the second time when the prices of Reliance fell here at 2519, you can see that RSI on the 25 period chart took support at the level of 40. Now, during my lecture, I also spoke about the concept of range shift, that when it's in a bullish range, when a stock is on a bullish range, prices tend to move up. So a lot of times, instead of going all the way to 30, prices will also take support at the level of 40. So the range kind of becomes 40 to 80 for intraday charts. And for the daily or weekly chart, you might want to look at 30 to 70 plus. So this again, this is again a very good indication from the 25-minute chart, 25 period chart compared to the 14 period chart, that like better indication of the underlying trend, as I was saying.
Okay, so generally RSI 60 is felt as a strong momentum for any stocks. But how much the importance of direction of the RSI is important, if it is falling from top to bottom or going from bottom to upwards?
I think the direction of RSI is very important. Because, like I said, the whole game of swing trading is identifying the trend and making sure that you are on the right side of the trend and you are playing the swings which are in the direction of the trend, and not because they tend to be stronger and bigger, which we also call the impulse waves, if you go by Elliott wave theory. But on the other hand, if you are looking at RSI on an absolute value and not, as the name suggests, relative value, you will make the mistake of entering the stock too early, getting your stops triggered unnecessarily, and then probably missing out on a very good swing, which could have otherwise made money for you. So you do not want to, like, say, okay, let's take this example here. Now, if you entered the stock here at this point of time, yeah, or if you entered the stock here, when, suppose you saw that, okay, fine, RSI, you know what, it has already touched this level, and I want to enter the trade somewhere over here. Though just RSI approaching the level of 30 is not enough indication. You would want to wait for some better kind of indication. You see that the price is already formed like a low here, yeah, and before this particular candle on the 8th of March at 1 p.m., before this was formed, you decide that, okay, I see the price already forming a lower low, but I don't see the RSI falling. In fact, the RSI I see is kind of higher at, what is this level? Let me I see RSI at a higher level of say 35. So I will call this a positive divergence and I will make my position. But what happens is in the next 75 minutes, price continues to go down. This is a small move. This particular one may not trigger your stop loss, but still it will cause you anxiety. What you instead want to do is you want to wait for RSI to finish its downside move and start moving up. Yeah, you want RSI to have touched or at least approached the level of 30 on the 75-minute chart with the 25 period makeup, approach the level of 30 and then start moving up, have at least one candle closed, which the candle itself may not be higher than, the previous candle, but you at least want your RSI to have closed above the previous one in order to make a position based on this. Based on this setup. So that is the reason why, you can avoid a lot of unnecessary stop losses and a lot of unnecessary anxiety simply by using this direction of RSI rule. So I have this whole flow chart that I like to refer to before I get into a trade, where I have like, is RSI above certain level? Is it going upward? Is it going downward? Has it already bounced from 200-day moving average, or is it below moving average? And I like to follow that whole decision tree before, I can actually follow in, because a lot of times in trading, when you're looking at the screen and you're looking at the stocks and there's this sense of urgency and this excitement of executing a trade, we tend to overlook our checklists. But having a decision tree which is laid out in like ink and or maybe on a sheet, referring that helps me at least maintain a lot of discipline in the market.
There is a question for you. In this Reliance example, where we should put our stop loss?
Okay, so in this Reliance example, okay, so for putting the stop loss, I would have to do like a more in-depth analysis, look at the daily chart and so on and so forth. So this is the 8th of March, which would be something even older. Okay, so suppose it's here. So in this example, if I were to take this trade here, my stop loss would be somewhere around this level, which is, I need to minimize the screen. So I would basically look at this resistance, this resistance turn support level here, because this is over here, you can see there is a cluster of price activity. Now, because this was a very new low, on the 8th of March, you'll have to kind of go behind and look at older price history and look for cluster of, price action. So this is a pretty good zone. So I would like to mark it, and if you extend it, you can see more proof for the same. This is ideally where I would keep my stop loss, which is I think is 2,145, which is pretty reasonable. Say suppose your support level here, so this is your support, okay, so this is around 3% lower. Now because I want to keep a bit of buffer, I would probably go in with a support of 4.3 or 5% for this particular setup.
So there are two indicators. One is RSI, and what is the other indicator that is shown?
Yeah, so this is actually the money flow index, and I've started using this index very lately. That is the reason I did not cover it in my webinar. I'm kind of studying it. It's been 6 months now. The reason to include this in my study was RSI does a great job in the whole price momentum thing, but it leaves out an important component, which was volumes. And again, volume is a very important indicator when it comes to determining the strength of any movement. And it's especially very helpful when RSI is showing negative divergences. And if you have drying volumes, it's great. When RSI is showing a positive divergence, and if you have strong volumes, it's also great. So what the money flow index basically does for me is it shows me good, it shows me positive divergences when the price is maybe not moving that strongly, but volume is starting to build up. It's a good uh, uh, indicator for identifying accumulations. But I'm still very new with this indicator, so it's not something that I talk about very often. Or at all, actually. This is the first time I'm talking about it with somebody else.
Okay, thank you for your presentation.
My pleasure, Karan. Are there any more questions from our audience?
That's there was what will be EMA and RSI on monthly chart for swing trading?
RSI on monthly chart. Well, I do have RSI on monthly chart, but I usually do not use it that much because, again, if you're using monthly chart to make your decisions, you're probably not swing trading. Instead, I believe you are more likely long-term investing. So on the RSI, on the sorry, just a second. On the monthly chart, I haven't even changed the RSI. It's still, it's just 14 period because, however, I did change my RSI on the weekly chart to 8 because then that gives me a visibility of 2 months worth of data rather than, 14 weeks. So I want my weekly chart, weekly RSI to be more volatile because a lot of times RSI on the weekly can be very slow in, giving indications. So I want it to be more volatile. That's the reason I use 8. But on the monthly chart, I don't use RSI. It's not really swing trading. It's more long-term investing if you're referring to monthly charts to identify your trades.
Can you see the chat box?
I can.
So there is one question, if you can reply that.
Could you please explain the Alok industry entry?
No, that is not the latest one.
Which is the other RSI you're using? The other RSI, the blue one, we just talked about that. So the money flow index.
No, in the chat box, you are seeing the Q&A.
Yeah, I am actually seeing the Q&A. You're right. Let me look at the chat box. Okay. I see 58 messages. Sorry, just give me a moment. All right. Confused with a lot of information in market. Is that one by Mr. Rakesh?
Yes.
Okay. When no information had made money, but a lot of information have and losing money solution fees. See, Rakesh ji, that is the whole game. The whole game is of information and having the ability to, like I said, it's like finding a needle in the haystack. It's only with a lot of practice that you will start identifying what is news and what is noise. And that ability is, it's not a superpower. It's just a lot of practice. You will, I would tell you, avoid headlines because headlines barely have anything new. Headlines are just, for making money. Headlines don't make you money. They are for the business house to make money off. So I would say, instead of trying to read everything everywhere, try to look for news, try to browse through, newspapers. Economic Times, I feel, is a very good source. The paper, not the website. I find the website very overwhelming with a lot of information, lots of articles broken down into way too many categories than necessary. And the newspaper is a great way of just finding those little corners of important information. I would really suggest everybody here to please subscribe to the newspaper, the pink paper, and start reading that every single day. It's a very old advice, and I know times have changed and apps have become, on your fingertips, but it's just too much information and too much to deal with and too much distraction to actually be able to focus. And I've been reading the ET since so many years, and I have usually found my best picks while reading that paper, and barely out of, there are other sources as well, but I think the ET works the best. The pink paper works the best. Are we also looking at other questions?
Well, that's it.
Okay, sweet.
Thank you, ma'am, for your enlightening session.
Thank you so much for having me here. It was great presenting to the team. Thank you, Karan.